do all my reporting, and what else? And supervise the girls that do the foreclosure prevention counseling. So the last time I was here, I said those two words, foreclosure prevention, and we got off on a tangent. So today I printed for you some slides so that we could kind of stay on track, get through who we are, what we do, talk about the county program, and then at the end I'm sure we'll have a little bit of time, and then you can ask any questions that you have. I will tell you guys, and Howard knows this too, it's kind of hard to reach me because I'm always doing something, so usually my phone is on Do Not Disturb, quite the opposite of what you guys do with your phones. The best thing to do, leave me a message and then also shoot me an email, because my emails I'll check a lot throughout the day, and I can get back to you even if I can't talk on the phone because I'm doing training or something. I can sometimes get back to you via email. So if you have a question you need to ask, just put urgent, need to ask a question, tell me what it is, and I'll try to answer it just in an email without making you wait for me to call you back. So today we're going to talk about Bucks County Housing Group, who we are, a little bit about how we get our funding, tell you what your clients can expect when they meet with a counselor. Why would you send them to a counselor? Because I know some agents used to be very concerned about sending a client to a counselor. And then at the end we'll talk about the county program. We are a 501c3. We're a nonprofit, so when you hear the word Bucks County Housing Group, we are not actually a county organization. We subcontract to the county to do the counseling for their program. Okay? Our primary role was to provide permanent housing for low-income families, usually women and children, so that they would be self-sufficient. And as an addition to that housing continuum, we then added foreclosure prevention in '84, and then the first-time homebuyer program started in '93. Actually, the first loan was made in '94. The program was created in '93. Some of you have done continuing ed. You've heard about Act 137, perhaps? Yes? No? Okay. Act 137 was enacted by the state legislature to allow specific municipalities, not Pittsburgh, not Philadelphia, to create a housing trust fund, and the money from the housing trust fund comes from the recording fees when you guys sell a house, and then that money is used to promote affordable housing and other related activities in the county. Okay? So that's our continuum. We have a website, www.bchg.org. You can look on the website to learn more about what we do in the other areas. We are HUD approved. We are also a member of the Pennsylvania Housing Finance Agency Counseling Network. We are supported also from United Way of Bucks County. If you contribute to them, you can designate that your gift go to us if you don't have a specific donor that you like it to go to, or recipient that you like it to go to. And so we do the counseling, we provide information about programs, we provide the counseling to the client free of charge because we're getting paid from these other sources. The clients know that regardless of who is funding the counseling for them, they are not obligated to take any of the services or programs that we talk about when we're there. It's really just to help them make an informed decision for their households. We also use volunteers to help stretch our payroll dollars. My department right now consists of 2.5, or actually 2 1/3 people. So it's me, the foreclosure counselor who's out right now on an extended leave, and then I do have somebody who has now started helping me with admin, but she also helps 2 other people. So I only get her maybe 1/3 of the time. So that's us. And so we do use volunteers. I have volunteers. Actually, you guys probably know Diane Loomis, so she has volunteered with me for a long time. I have some folks from banks that come out and volunteer. Our staff is prohibited from having any kind of a relationship with a client for at least 1 year after services have ended. And so the same thing goes with the volunteers. Any of our volunteers that come out know that they're not allowed to prospect for leads when they come out. You know, it's really just because they have a commitment to the work that we do and they want to help. So we do have a lot of realtors that help. The other way that you guys help us is through the apartment partners. So my department, the housing counseling department, is only maybe 4 or 5% of our total overall agency budget, and the rest of it is for the shelters, for the affordable rental units, for the transitional housing program that we do the case management for. And so the realtors always pull together in October, which is your reach out month, to do backpack stuff, to do apartment partners. So what you're doing is actually refurbishing an apartment for a new family who's moving in, a homeless family who's moving in. So we thank you for all those contributions. I know you've also done food drives for us for the food pantry, so that's terrific. While we're doing our housing counseling, we have to promise to provide our information confidentially, respectfully. We have to be honest and forthright when we give factual information, when we're giving information. And so our agency and our counselors all subscribe to the national standards. So it's very similar to the things that you guys agree to when you become realtors or when you become a member of BCAR. You know, you have those ethics and standards as realtors that you have to subscribe to, and so we do too. One of the things that we do with our application is we ask the client if they have a relationship with a realtor and with a lender. And if the answer on the application is yes, then we make every effort to make sure that when we meet with a client, first of all, that we let the lender know and the realtor know that the client is coming in, that they intend to apply for the county program if that's what they're doing, and then we try to keep everybody informed as to what's going on. If they don't tell us, we don't know. And so there have occasionally been some snafus, but we try real hard to maintain that relationship when you refer somebody over to us. Yeah?
Question, you said a few snafus. What do you mean by a few snafus?
Well, I have one that I can remember. And that was somebody from Trident Mortgage had sent a client over. He didn't send me an email to let me know. I asked the client if they were working with anybody. They said no. And they asked about programs. And so I told them about a program that Trident didn't sell. And so he called me to say, why did you tell my client about that program? And I said, oh, that was your client? Because I have the application here and it doesn't say anything about Kent, you know? Right. So he got it. Right. And that's one specific occasion that I remember forever and ever because I happened to take his call. My mom was in the hospital and I took his call at the hospital because he left me this really, you know, angry voicemail and I needed to
reply. Message.
Yes, it was a very unpleasant message, and we worked it out and he understood. I don't want to refer any of your clients away to somebody else, to another realtor, to another lender ever, and so that's why we ask. Our application didn't used to ask that, and I made sure that I instituted that as a measure and as a way to keep track. So the thing that I'm going to tell you is always remember to email me too and follow up, and then we're all going to be on the same page, okay? So the first assistance loan, like I said, was made in 1994. Through June of this year, we had 596 first-time homebuyer loans that went out. I have notes here. I can't read them though. The mortgage loans totaled more than $64 million, and the county money that was invested was a little more than 3.6. So a lot of money through the county program. Now, let me just say that we are HUD certified. We do the work for the county. We work for PHFA. Your client doesn't have to use PHFA. They don't have to use the county. So what we try to do is kind of give them some options and see what works best. I like PHFA because they get other things along with their loan. They can get a mortgage credit certificate. They get no mortgage insurance as opposed to FHA, which comes with mortgage insurance. We try to do the math. Most of the time I'm going to defer to the lender. I'll let the client know what's out there, but I'm going to let them defer to their lender when they speak to them to see which option is the best. Now yesterday I spoke to a lady. The first option, she was already working with a lender, not Centennial, and they were doing 100% financing. And they had a program that they were going to put her in. So that was the least amount of money out of her pocket, and it was an okay payment that she could afford. but she was probably going to be, he had only pre-qual, not pre-approved, and so she was probably going to be over income for that. So then we gave her a second option with a different program, and that kind of roughly gave her the same, it was actually a more expensive payment, but still very little money out of pocket. And then the third option was to go with the county program. So that was the most money out of pocket, but it was also the lowest payment. So the lender is actually the one who's going to drill down with the client and say, well, how long do you plan to be there? And then ultimately help the client decide what's better. Is it the more money out of pocket and the lowest payment because you're going to be there 30 years? Or is it the least amount of money out of pocket because your plan is 5 to 7 years? And so a lot of times, you know, as I said, we'll give the client the options, but ultimately they're going to figure that out with their lender when they meet with them, okay? And sometimes lenders have other programs that I just don't know about. I try to stay on top of it all, but I don't always know it all. So the county program is the one that's been around the longest. It's the one that's always funded, and so that's the one we generally talk about the most. And so you have a slide that talks about the basic criteria for the participation in that program. Residency, income eligibility, ownership, location, assets and income, purchase price, characteristics of the first loan, and characteristics of the county loan. And we're going to talk about each of these. Let me reiterate, clients don't have to be eligible for the county program to come out. So Howard sells the PHFA loan. That requires a counseling certificate. We can do that. We can do it face-to-face, or we can do it in a workshop format. We offer our counseling in both of those ways. We were doing an 8-hour class, and a lot of the Keller Williams realtors were sending their clients to the 8-hour class to get the certificate, and then they were using the county money and dropping off their paperwork maybe and not coming to see me face-to-face. Last 2 months, we didn't have enough registration. We had registration, but we didn't have enough to really do an 8-hour class. So we haven't had one in June. We didn't have one in July. So what I'm going to try to do is shrink that 8-hour class down to a 4-hour class. And we are requiring that every client that comes to us, unless there's a language issue or unless there's a technology issue, every client has to do a 1-hour webinar first. Now the webinar, they can do it in their pajamas. They do it from their house. All they need is an internet connection. And they can either use their speakers from their computer or they can dial in from their phone. We do recommend that the webinar that they do it on a computer so they can see the slides. I had a couple folks with smartphones and iPads, and they said they were having trouble with the slides. And then it doesn't give them the opportunity to really ask questions because it's hard to type the questions in, okay? But the first step then for all of our clients is going to be to do that webinar. That's an hour, and then we're going to try to do the 4-hour classes instead of the 8. And then follow up with the face-to-face counseling. The webinars we're trying to offer once a week or once every other week. The 4-hour classes we're going to try to offer twice a month. In the past, the 8-hour classes I only offered once a month because frankly I wasn't going to give up more than one Saturday a month. But we're going to try to do that. And right here, right now, I'm going to tell you something brand spanking new for us is we are going to be offering online counseling. Now, in-person counseling, all the studies have shown that in-person face-to-face counseling is better for the client than a workbook or online counseling, but any kind of counseling is better than no counseling. And we've had, in the last month, 5 inquiries for online counseling. So folks who just can't make it into the office, can't come in the evening for one reason or another. The online counseling is going to have a cost. And we have not yet determined what that cost is. We have to purchase it for $99, and so what we may do is offer discount coupons, but we haven't quite worked that out yet. But you're the first ones to hear about it. So that will be an option, and then that counseling will not be free. So they need a counseling certificate for a lot of the programs, and they need one for the county program. So let's talk about these characteristics of the county program. First of all, residency. We talked about it out in the hallway. They have to either live or work in Bucks County to be eligible for the county program, live or work, one or the other. If there are 2 borrowers on the application, or 2 applicants, let me say, on the application, only one of them has to work here. So if you've got 2 partners, a husband and wife, you know, they live in Philly, maybe one of them works in Philly, but somebody else works in Bensalem, then they would be eligible to participate on that criteria. Yes, ma'am?
This is for PHFA?
This is for just the county program. Sorry, I know,
County, not PHFA.
skipping around a little bit. PHFA, I'll stop right there. PHFA is, yeah, we're looking at your slides right now. We can go over the other handouts, the individual handouts afterwards. So, but PHFA is statewide, anywhere in the state.
Oh, okay.
Yeah.
Great, thank you.
So for the county, you have to either live or work here. That residency requirement is waived if somebody is in the active military or retired military.
How about like self-employed, like if your business is in, like say Bucks County, it's dealing with realtors or something like that? Or like general contractors, if their address or?
If their business address is here,
Okay.
then that's fine. If their business address is Philly, no.
Okay.
Yeah. And I know that they work in Bucks, but they're not paying business taxes or whatever in Bucks. If they're not, you know, if the company isn't located here.
Alright.
Okay. Income eligibility. So income eligibility, we are going to use total household income, regardless of who is on the loan, okay? And a lot of the programs are that way. PHFA does ask about total household income. They want to know who's going to be living in the house for the next year. So we determine it based on family size. And so, you know, if you're a household of 4, these income limits are, oh no, they're right, okay. Family 4, 71.1. So we go up or down depending on how many people are in the household, okay? So it's not who's on the loan, it's who's in the household. Previous ownership, they do have to be a first-time buyer. The federal definition of a first-time buyer is someone who hasn't been on the deed to their primary residence for 3 years. So, you know, and if somebody lost a house 10 years ago or got divorced and sold a house 6 years ago, they're considered a first-time buyer again and they can participate in the program. However, if they own any other property, the county says no. So if they own commercial property, we're going to say no because they probably have equity in that. And then also, if it's someone who has used the program before, they are not eligible to use the program again, even if they are by definition a first-time home buyer again. If it's a once and done, okay? The house itself has to be located here. So I know, you know, some folks are located in Bensalem and selling in Philly. Other folks, you know, have clients looking in Warminster and then they kind of edge over to Horsham area or Hatboro. Horsham, Hatboro, that's Montgomery County. They can't use the Bucks County program to buy in Montgomery County. Just so that you know, there is a program in Montgomery County as well. Works a little bit like the Bucks County program. The only difference is your clients can be under contract and we can try to get them through if you're using the Bucks County program. I can't guarantee it because there may be some timing issues. In Montgomery County, they have to go through the counseling and be approved before they can make an offer on house. So that's one big difference, okay? Income and assets, so they have to be able to document for us that they are under income, so we're going to collect, you know, W-2s and 1040s. They also have to be able to show us that they have at least 3% of the purchase price that they are going to contribute to the transaction. So that example I gave you, you know, about the person doing 100% financing versus 3% down, they can't use 100% financing with our program because then they're not going to be, unless they're going to contribute 3% to closing costs. You know, often they aren't. And then there's another piece to that usually prevents somebody from using USDA or VA and using the county program. Not always, okay? On the other hand, they also have to have 1 month mortgage payment left in reserve. So they have to be able to show us, if their payment is $1,200, they have to be able to show me that they have the 3% plus $1,200 to move forward.
Sherry, is there a maximum that they can have afterwards?
There is, good question. So the maximum is 6 months PITIA. So principal, interest, taxes, insurance, and if they're in an association, the association fee as well is always counted in the housing payment. So that's what we would be looking for, no more than 6 months. Now that is one area. The county typically does not like exceptions. That is one area where we can sometimes ask for an exception. If they have a little bit more than the 6 months and the MLS printout says that the house comes with nothing but the stove, then I can make a case to the county, hey, they've got, you know, what's 6 times 12? Somebody do the math, 7,200? Okay, they have 7,200, but they've got to buy a refrigerator, they've got to buy a microwave, they've got to buy a washer and dryer, and that's going to eat up a lot of their assets. And so if they had more than 7,200, you know, if I send a printout of what a refrigerator costs, they'll usually make an exception on the assets. Okay. So the characteristics of the first loan, we just talked about it, PITIA. It has to be a fixed rate mortgage, has to be at least 15 years or longer, has to escrow for taxes and insurance, and most of them do now. There's very few loans where you are able to pay those separately anyway. What we look at is the front end ratio, what percentage of the gross monthly income is going to the house payment just by itself, and then we also look at the back end ratio. How much of the gross monthly income is going to the housing payment plus any debt that the borrowers have. Now here's where again it gets a little tricky. The lender is only going to use the income of the applicant. And the lender will probably let them go up to 43% on the back end. Sometimes I know higher, but let's talk about qualified mortgages, 43%. The county's limit is 41%. But when I calculate ratios, remember I'm using total household income to qualify them for the program. So I have also talked the county into allowing me to use total household income when calculating ratios. And I just let them know that only one person is going to be on the loan. So if Howard's going to approve them to a slightly higher ratio than we would normally allow, if there is that other documentable income in the household, then my ratio may fall right in line with his.
And that's like Social Security?
Yeah.
Or
Yep.
child support?
Yep.
Okay.
Yep, absolutely. So you have a husband and wife. The wife's disabled. She's on Social Security. She's got lousy credit because of when she got sick, you know, she had all these accounts and she didn't pay them, or she has medical collections. She's not going to go on the loan. So Howard's only going to use the husband's income, and he's going to take him up to 43 or 44%. When I add in that Social Security for the household, it brings it down to 41%. We're good. Okay? It's a difficult concept even for the lenders to understand because it's not traditional lending. So, but that's how we do it. Okay? There is a maximum purchase price. The maximum purchase price for the program is $261,000 on existing housing. Make sure yep, and $311,000 on new housing. And there has been some new housing that's been under that limit. I had somebody buy in Feasterville Trevos, not Centennial Station. I don't know, some station.
It would have been Centennial Station and gotten a mortgage.
Yeah.
It wouldn't have happened.
No. So, but it was somebody over in Feasterville Trevos, and they did purchase new housing. So, anyway, so the characteristics of the county loan. It is a loan, number one, okay? So it's 0 interest. There's no monthly payment. They pay it back when they sell. If they access the equity in the property, either through a refinance or through a home equity loan, because the lender, the new lender or the home equity lender is going to want to find out about that lien that the county places against it, and the county's going to say, we won't subordinate our lien if the borrower is taking out additional debt. If they're refinancing solely for better rate and terms and they're not financing more than the balance that's left, then the county will subordinate their lien to the new loan.
How long will that take a subordination from the county?
It depends if everybody's in the office and if they get, you know. What they have to do now, the county's gotten kind of strict about that, so they have to send them to me, and I'll just review it and make sure that, sometimes they'll do it themselves. If there's any question about it, they're gonna want me to review it and make sure that the payment's still affordable. We had somebody who was getting a divorce and wanted to take the wife off and refinance just in his name, and he was approved, but his back-end ratio was 55%. And the county would not participate because they don't want their lien to be in place on a property where the borrower is likely not to be able to, you know, the lender was okay with it, the county's just not. So we weren't able to subordinate that one. Most of the time, it's pretty quick though, Howard, yeah. And they wanted him to come and see me and me to look at the income. Now, they don't have to be income eligible because they're sort of grandfathered in. What the county's looking at is to make sure the payment's still affordable. Okay?
So they're not reapplying?
Right, they're just, exactly. Now, they did make an exception just recently on that. And there were a whole host of reasons why I told them that I felt it was in the client's best interest. First of all, if the house had been sold, there wouldn't have been any, the person probably wouldn't have gotten anything out of the deal. Even though the house appraised for about $20,000 more for what the loan was going to be, houses in that area really aren't moving. There were a lot of houses on the block that were for sale, so we wanted to keep that person in the house. The child was in a school district and special programs. We wanted to keep the child in that school district, which might not have happened if the mom had to rent. Wouldn't have been able to find a rental property with a payment that was any lower than the mortgage payment that was being proposed. And on the income that showed, the ratios were a little high, but we ran through the state website the expectation of what she could expect for child support from her husband, who had a steady job and had been there 15 years, wasn't going to go anyplace anytime soon. And so we could show that there was an expectation that she would be receiving additional income, you know, once her divorce was final and they were all separated and everything.
So basically, you're using some common sense.
Yes, and now, hooray, the county is using the common sense. In the past, they would not. So, you know, it was the rules and only the rules and stick to the rules, and pretty much that was it. So now they are evaluating it, and some of that has to do with the fact that they have a new director of business, or it's not business and community, it's housing and community development now. His name's Roger Collins. You guys might know him if you ever did any work with the Opportunity Council. He was the executive director there, and he moved over to the county side. So he does review these requests that we put through to see if they make sense. Yeah.
We actually have a scenario, the woman, and she works part-time, we can't use her part-time income because she hasn't been there for 2 years.
Mm-hmm.
She is getting child support for her daughter, and her ex is like $95,000 in arrears.
Oh.
But her daughter's in college. Like, how does that work? I mean, she's gonna continue getting it. I know we're trying to figure out how long she's gonna be getting it for, like what's in her divorce decree.
Yes.
But say, for example, it's when she graduates.
And she's
But she still owes, as she is 19, yeah.
Oh, so if it's when she graduates, you know, we would probably look at that as well. I would, you know, make a case to the county that I'm including the child support even though the child is 19 because she's in school and that's what the divorce, and they probably wouldn't even ask me for proof the same way that, you know, in the same way that you would have to prove it.
Okay.
I might have to get it.
Oh, you did? Okay.
Yeah, the ratios are 59.
Oh, so that's not gonna work. Yeah.
Not 59, like 59.
Yeah, not gonna work.
Okay.
And I would count the part-time income, but even though it wasn't a 2-year history, I would count it, but yeah, if the ratios are above
Yeah.
41, it's not gonna
Sorry, I
happen.
didn't know she already is.
That's okay. It doesn't hurt to run it past again, because, you know, some days I have off days and my thinking cap's not quite on straight, so. Anyway, so we talked a little bit about the subordination. This loan from the county is interest-free, but it will always, 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 always have to be repaid at some point. So, you know, I have clients say, well, what if I just stay there? Well, okay, so you just stay there. Are you going to die in the house? Because then your heirs are going to have to pay it back. Somebody's got to pay it back, okay? The county is not a fan of forgivable liens. We tried to get them to change that, but they wouldn't. So we'll keep working on it. And you guys can make that case too. In fact, some of the changes to this program, now most of you haven't used the program like way back in 99 or 2000 or 2001. In 2008, the program changed significantly, and we didn't think for the better. In the past, it was only open to families, so single applicants couldn't apply, and we got that changed. And the realtors helped us do that. The president of the Bucks County Association of Realtors spoke to the commissioners, to the then director of Housing and Community Development, and we got some changes. The changes about the combined loan to values on, which I didn't talk about yet, but on VA homes, we got that changed. And so there have been changes, and you know, if we push a little bit, maybe we can get some of the other stuff changed. Anyway, how much can they get? The program maximum is $10,000. That's the maximum. The amount that they are likely to get typically matches their down payment. So if they're doing a 97% with 3% down, they can roughly get 3%. If they do a 95% down with 5% down, they can usually get 5%, as long as their assets aren't over that 6-month PITI asset limit, and as long as, well, in that case, they'd be doing conventional, so they'd probably only be getting a 3% seller's assist. It changes if they do FHA. FHA is a great loan. It's good for folks who aren't income eligible for programs. It's good for folks who have significant debt. It's good for folks who want to use a gift for their whole down payment. It's good for folks who want the whole 6% seller's assist. If you guys are aggressive in your offers and you get a full 6% seller's assist, the client is likely not going to be eligible for very much. When I say that, Helen Irvine, who you guys may know, had a client who was, when she first met with us, we said, okay, if you do the FHA deal, you're probably going to get around $4,000. Helen wrote a great contract. The seller was given 6% seller's assist. The borrower only needed $800 to make it happen because they had to contribute their 3% to meet the county minimum guidelines. The seller was paying a good portion of the cost because the lender kept the cost really low. So, you know, they really only needed $800. That particular borrower chose not to take the money. Now, I'm going to say to you, it's zero interest. There's no monthly payment. Why don't you take the $800 and you keep that $800 in your bank account so you don't have to spend it, you know? But it really is the borrower's decision. We can go all the way up to the point of requesting the check and they can change their minds. So, so that's really the bottom line. The amount they're going to get is ultimately going to be determined by the purchase price of the house, the amount of the down payment and the loan type, the amount of seller's assist, and the amount of assets that the borrower has in the bank. And we calculate how much we're going to give using the good faith estimate from the lender. I am not 100% sure. I guess you still have to give a good faith, Howard, right, with this new TRID stuff?
Well, let's talk about that October 3rd.
All right. So for right now, we're going to use the good faith estimate of closing costs, and I don't know what's going to happen
It's a loan
when
estimate.
it will. Yeah, that's going to, and it's not a borrower anymore, and it's not a lender anymore. So, and you're going to consummate
realtors don't know
those
anything anymore,
deals,
so
right?
I'm not allowed to tell the realtors anyway.
Oh, okay. So, anyway, so I don't know how we're going to do it, you know, with all that new stuff, and I need to really find out about that. But for right now, we have to have the good faith estimate. You do have a slide which you guys probably cannot read. Maybe you can. I can't because I have bifocals. But it is a transaction comparison, and it shows the difference between an FHA deal and a conventional deal. I ran them both using, I think, a 5.5% rate. So we all know that FHA just with no special programs attached, is probably a very inexpensive rate right now. And so that might be the better way to go. You have to do the math and see, what does the borrower end up paying. So the county program can be combined with FHA, with any loan through PHFA, with a conventional loan, an in-house lender program. What they can't use is an adjustable rate mortgage, or one that doesn't escrow. So anything at all, okay? But there's just sort of an idea of how much they could get. Understanding that, in fact, the rate would not be the same on those two loans.
Pretty much in the back.
I'm sorry, I didn't see you.
Hi, that's okay, I just put my hand up. So if I've been showing a client a house and it's a single person and their income's under 56.8, he should come talk to you?
Yeah, yeah.
Is it in Bucks County?
Yeah, if he lives in Bucks, and you know what?
Well,
You
he's
don't
living in
even
Bucks.
you don't even have to qualify them, because remember, they don't have to be eligible to come for the counseling. If they haven't made an offer yet, that's probably better. I will tell you that I'm booked out right now to the second week of August.
Okay.
I don't usually get that booked, but I mean, I've just been going crazy. The appointment itself is going to take close to 4 hours. By the time we review their application, review their credit report, review their budget, do the action plan for them, complete for them a financial analysis, it's going to take, and make copies of all their documents that I have to have in file, it's going to take close to 4 hours. So I can really, at the most, usually do 2 clients a day, and I'm not going to do that every single day of the week, because then I don't have any time to come out and talk to you guys about the programs, or catch up, or do phone calls and return my emails. So I usually see no more than 5 clients in a week. And so right now that means I'm booked out to August.
So should they see you before they get pre-qualified?
They can, absolutely, or they can see their lender. We'll see them regardless. Sometimes, if you have a client that has unrealistic expectations, it's nice to send them to me first, because I'll tell them the truth, and you don't have to be the bad guy. So we can sit down and talk about what their income is, what their debt is, how much money they have in the bank. So, they have a 585 credit score. They want the very best mortgage terms. They don't have any money, right?
And they want to live in your name.
And yes, exactly. Yeah, you know those clients. So.
Would you rather not have these people already pre-qualified before they come see you, so we're not wasting time?
No, it's never a waste of time, because we're going to do that budget with them. And for us, that's one of the most important pieces of the counseling, is to do an effective budget. It's not your job, it's not the lender's job, it is my job. HUD requires that we do a budget. So it's important that we talk to them about what's really affordable. And that's the question that we have, because the lender may be willing to lend to a certain level, but the lender doesn't always know all of the client's expenses. We know the debt, because the lender has to pull a credit report and use the debt that's reported, but they may not know all the expenses, and borrowers may not be willing to make adjustments on those expenses.
Years and years ago, as I always say, back in the day.
Back in the day.
You helped somebody out, they went for the budget, took them a year, but they did it. They had no credit at the time, told them what to do, and.
Yeah. And we can help with that too. I believe, and correct me if I'm wrong, I believe that now with the new rules under Frank Dodd-Frank, whomever, when a borrower comes in and goes to a lender and the lender pulls the credit report, the lender's no longer supposed to give them coaching and tell them what to do to raise their credit score. And they're not allowed to tell them that they should pay off debt to reduce their debt to make their ratios better. I don't have those same constraints.
It's very important.
Okay, I do that like 5 times a day.
In a lot of instances,
It's between you.
is You use the term pre-qualified, and really what we do is pre-approved.
Yes, that's a
She
difference.
can really pre-qualify and give them direction,
Yes,
okay, to get to the point where we can pre-approve them.
yes.
So it's probably beneficial if they're borderline to go in that direction.
Well, my thing is, like, I'm not putting that person in my car, driving around showing a house until I know they pre-approved
Uh-huh.
for a mortgage. That's my thing.
And that's what we tell clients. There's a difference, and again, this is sort of gonna change in October with the new stupid rules. I didn't say that. Are you recording stuff?
Yes.
Well, and you know, and well, some of them are less consumer friendly than the folks who instituted them, I think, would like, or believed that they would be. So, but that being said, right now, a pre-qualification, your borrower calls up and says, I'm earning this much, here's what my car payment is, I have $5,000 in the bank, and they get a letter that says, great, go out and look for a home for, you know, $175,000. And then you find out that, in fact, part of it is part-time work, part of it is child support that's not going to continue. They do have a card payment, but they forgot to tell you about their 4 credit cards. And, you know, so their income is not all the income, the lender's not going to be able to use it all. Their debt is higher than they thought. So the pre-approval is what we tell folks to get. And like Howard said, come to us for the pre-qualification first so we can talk about all that. And we talk about that in the webinar, but they still don't always get it until you sit down and highlight it for them. This doesn't count, this doesn't count, this does. Oh, what about this? Oh, and the lender has to use everything that's on your credit report unless it can be shown that it's inaccurate. You know, you have a credit card, you told me you paid it off, but it says there's a minimum payment due of $19, you know, and there's 5 of those. So, you know, it's $100 in debt that the lender has to count. So we talk about that stuff before they go. And so if you can do it that way, that's the ideal way. If they've already talked to a lender, if they already, you know, they want to go out tomorrow and I can't see them, well, if they have some money in the bank and they can do it without, go for it. I would never tell you to hold somebody back if you think they can do it without the county program. And if you get them under contract, you can still have them come out and talk to me or call and see if they're eligible for anything. We just can't, you know, well, we can never guarantee, right? Even if they do it the right way, we're never going to guarantee that they're going to be eligible. So unbiased, you know, I'm going to get paid regardless because we get the money from HUD, from PHFA, from the county, from all those places. So we can ask, you know, they can ask us those questions. And once again, you know, they're not obligated. I already talked to you about the webinar and the intake. It's 1 hour. And part of the reason for that is because we have to collect demographic information. We also have to disclose to clients who we are, how we are funded, just like I did to you guys today. They have to know that they are not obligated to use the programs that we talk about. So even though I do talk about PHFA, they don't have to be buying PHFA. They don't have to use the county program. So we have to do that all, and instead of doing it individually, I'd much rather do it sitting at my desk for an hour with 10 people on the call. Makes just, and then that also weeds out folks who really aren't ready. Now, if they think that's going to take them a year, they can still come in and meet with me, and we'll develop a 1-year action plan for them. Here's your budget, here's how much you should have left over at the end of the month. You know, go back, figure out where you're spending your money because you don't have any money in the bank. Figure out if it's needs or wants. That's what I talk to them about. I'm not a realtor, I'm not a lender, but I do talk about needs and wants so they can make it happen and get their, you know, get their dream accomplished. I did talk about the appointment, that it's going to be maybe up to 4 hours. I usually do them at 10, 1, or 1:30, 3. Remember, a 3 o'clock appointment is going to take us till 7. So, yeah. So I will do even 3:30 and in some cases 4, depending on what's going on and what the client's need is. I don't ever want to put a client in a bad situation, you know, if they don't have a lot of time to take off. We do ask for a lot of documentation. I think you have a slide about that. So photo ID, I have to know that they're who they say they are. The application, we ask for them to submit it in advance. I am not giving it out to the realtors any longer. I used to do that, so you'd have them to give. They have to do the webinar. Everybody that attends a webinar gets an email from us with, for your protection, get a home inspection, that same, form that we all have to give out, the application, the county guidelines, and some other attachments. We have to document their income, their savings. We need W-2s and 1040s. And some programs ask for 1040s. PHFA used to ask for 3 years when everybody else was asking for 2 years. So, we try to get them prepared for the loan application by getting them organized ahead of time and getting these documents out of the envelopes and into a file where they are easily reviewed. Some of the things that are missing from here, if they do use the county program, the next slide shows the things that I need for the county program. So I like the multiple listing printout just because it's a nice, concise description of the house. The agreement of sale, obviously, the home inspection report, they must get a home inspection if they're going to use the county program. And Howard and I had a deal 2.5 years ago. We were just talking about it in the hallway. He had her approved, but it fell through on the basis of the home inspection. The township was requiring they take down 6 trees. There was work that needed to be done inside the house. It was just a mess, and she didn't have the money. So, and that was actually not the home inspection. That was, I think, the county, and it was a combination of the township and the home inspection.
Just to be clear, Sherry wants to see the home inspection, we don't.
Yeah, the lender does not ever want to see the home inspection, okay? Never. And the county is not making a decision based on the result, but actually the trees were not the home inspection, I think the trees were the.
That was a tree, that was an encroachment, I think.
Yes, it
what
was.
ended up being.
So that, it wasn't the home inspection issue, but there were some other things in the home inspection that made the client nervous, understandably. The county is not going to base their decision on what's in the home inspection either. In fact, I don't even send it to them. I have to make sure that the borrower has it because the county wants to ensure that the borrower is informed. That's what they care about. So if they decide to move forward, with the home inspection, with whatever it says, that, because let's face it, no home is going to have a perfect A on their home inspection. Every home is going to have something that the home inspector can find. That's their job, right? So the county just wants to know that they're informed. We do want to see a copy of the 1003. I've had, sadly, a couple clients that were trying to commit fraud. They told me it was 2 people that were going to live in the house and, blah, blah, blah. And in fact, it was a co-signer or a co-borrower, which was not permitted, who was already a homeowner. So I do look at the 1003 to make sure that what they're telling me is what they're putting on their loan application. The estimate of closing costs, the TIL, that's part of the package, so if you have it. I need to know who the title company is because the check is payable to the title company. And then the total report, the appraisal, ultimately the loan commitment. Right now, if the good faith is, if the dates on the good faith are good on or after the settlement date, we can move forward with the good faith and just collect the commitment once it's issued, because sometimes that's not issued within 20 days of settlement. And that is the document deadline if you want the check mailed. If you want to settle Friday, we would have wanted the check issued last Friday. Friday's the day for the checks, by the way. They only come out on Fridays. It's the government, it's the county government. I don't write the checks. So they only come out on Fridays. No snail mail, no overnight mail. So your options are mailing it to the title company or picking it up on the day of issue. So if you're settling this Friday, you wanted it issued last Friday, I would have had to submit the application the week before. So Tuesday's the deadline, okay, on the week before. If we miss it, you still have the option to pick it up on the day of settlement. Hopefully it's not the last Friday in the month, because then the title company's not going to be happy that they have to wait until after 1 o'clock, because that's when the checks are available. Okay. Questions? Okay. So we'll just talk about these other little handouts before you go. We started a little late, so we're actually still 3 minutes ahead, so that's good. You have facts, frequently asked questions. So you can read through them, I don't have to read those out loud to you. It's just reiterating, why should they call, who can come, do they have to buy a PHFA loan? Do they have to use a realtor lender recommended by us? In fact, we try, bye-bye, not to make recommendations. If we do the same thing you guys do, 3 to 5. You know, I have to give them a group, I can't just refer to one person. They can pick who they want. If I go to a workshop, am I automatically applying? Am I automatically approved? No and no. So that's that. You have the criteria that we reviewed in this 2-page document. And then finally, you were looking at the PHFA paperwork that just talks about some of the different things that they have. And our counseling certificate is good for PHFA and the county program. PHFA's income limits are different. It's $87,500 for a household of 1 or 2, $100,500 for a family of 3 or more. So sometimes if they're not eligible for the county, we can talk about PHFA, and then they want to look at straight FHA versus PHFA with the FHA, because there may be a significant difference in the payment that would make them stay away from PHFA, because their rates are higher. That's it? No more questions? Oh, yes.
On page 4 on the income, row, for a family of 4, it goes down.
Yeah,
Or is it 77?
all right, so, look at that. I think that probably, it's 81.1. On this one, it's right. On my slide, it's wrong. Sorry. It's 56.8, that's the same, right?
Right.
64.9, 73 for a family of 3, 81.1 for a family of 4, 87.6 family of 5, 94.1 family of 6, 100,600 for 7, and 107.1 for 8. I probably just did a typo when I was making the slide. Thank you for pointing that out. I'll make a change.
What do they call the number on here?
Yes,
Make an appointment with you?
215. Oh no, I'm sorry.
You changed the number.
Well, Sherry made a couple mistakes here. You can't get good help these days. So the phone number and the fax number that are on this page are from our Wrightstown office, so that's wrong. The correct phone number is 215-394-8259. And actually, they'll just get my voice. I have cards here, so yeah, write it down. 215-394-8259. I think it's on the, it is on the slides. It's on the slides. It's just wrong on the handout. And it's there, yeah. So, whoever fixed my letterhead template didn't fix the phone numbers.
Ours is correct, yours is.
This one is
Ours
right?
actually is correct.
Yeah, just the county one's not right.
No, it is.
No, we have the
It
right
is.
one.
It is right.
That's the facts. This is the county guidelines. The frequently asked question paperwork is right. The number on the county guidelines is incorrect. Participation. Participate, don't hand it out, Howard. Okay, yeah. You might not have it.
Yeah.
Okay,
We didn't have
good.
that one.
Excellent,
We
good.
didn't have that one.
That's perfect. They knew it was wrong, so they didn't print it.
All
All right, and I have cards here too. When they call me, they're gonna get my voicemail 9 times out of 10. And that's gonna refer them to our website to register for the webinar. So you could even just refer them right to bchg.org to register for the webinar. They will tell us that they're working with a realtor because we asked them that as an exit survey. And if they don't answer the exit survey, then it will be on the application that they send to us. And then when they come in and meet with us, we'll send you an email and say, your client is scheduled counseling and here's when it is.
And you do that every time? I mean, you will contact the realtor?
I try my hardest. I'm not going to say that I've never forgotten, but yes, that's my process. Yes.
Could you go through those, the PHFA?
Yeah, sure.
Income limits?
Sure. It's 87.5 for 1 or 2, and 100,500 for 3 or more. 1 1 and 2.
For 1 and 2 people.
Mm-hmm. And 100,500 for 3 or more.
People in the household.
And then, you know, yeah.
That's household regardless of whether one's buying or whether.
Yes. Yes. And they are asked to sign a borrower affidavit at settlement to say who's going to be in the house and what the income is. So, you know, if they lie about it, they're committing loan fraud. So, they don't want to lie. Yeah.
Question. Aside from the income, what if one of the people already purchased the property?
So some of the PHFA programs are for first-time buyers and others are not. But I think there is a rule in there that they can't currently own other property and use the PHFA loan. They can use it for a refinance.
Because I have a client right now that's purchasing, he's going to live with his girlfriend. She's not going to be on the mortgage because she has her own property to sell. So would that make him ineligible?
Well, is she going to be on the title and
She'll
deed?
be living there, but she won't be, she's not going into the purchase.
They have a gray area there, I think.
A gray area, yes, if they make their application and do not put her as part of the application.
He's buying it just on his own,
Correct.
Yeah,
without her, and they're not married yet.
and they're not
Correct.
married. Then you
They could always break up.
yes, they could, because they don't have a bank account together, they're not reporting their income together, so essentially he doesn't exist, or she doesn't
She doesn't.
exist. Yeah.
Right.
Okay. Yeah, if they have a joint bank account, then that's a red flag. Yeah. So, and PHFA isn't always the best option, but it can be, depends what the rates are. They have a 3% down, no mortgage insurance option, which is usually a higher rate than the government rate. Sometimes though, that higher rate still nets them a lower payment when you take away the mortgage insurance, but not always. So I just did one for somebody who was, you know, locked in at a 3.75 rate, and I think PHFA's rate is 4.75. So that 1% difference, actually the FHA loan was less expensive even with the mortgage insurance. So, and they can do an FHA loan with PHFA, but then that rate's higher than the market rate. But they can get a mortgage credit certificate, which gives them a dollar for dollar tax break on their tax return. This is, okay, so here's real confusing. Whatever interest they pay, divided in half, and up to $2,000 of that half is their tax break. So you can get a maximum tax break of $2,000, and that's an actual dollar for dollar reduction of their liability. So if they usually get a $1,000 refund, they'll get a $3,000 refund. Okay? The rest of the mortgage interest, the remaining half above $2,000, and the other half, they can just take as a standard mortgage deduction. He would give them the mortgage credit certificate.
Is that just
Or
1
come
year?
out, come out.
The first year?
Or shoot. Yes. Sorry.
Sorry,
He's right in my line of vision, that's why.
That's all right.
Is that just for the first year? Of
I
the-
know, for the life of the loan.
That's the
But
life
of
of the
For
course,
life alone, you
yes.
have that much interest, whatever you
yes.
paid by?
So, I just talked to somebody who was borrowing well under the maximum PITI that would have been allowed to make it real comfortable. Meant there was going to be a lot of extra income. Wanted to stay there 30 years, but this way they were planning on making additional principal payments to pay the mortgage off. All the interest is lumped up front, right? So they're getting the maximum mortgage credit deduction in those first 10, 15 years, and then they're going to be paid off, and they will have paid that much less interest and gotten a credit back on their taxes. So, but you have to really look at the math. And these guys are set up to run those scenarios very quickly to see, you know, out-of-pocket, monthly payment, what ends up being the best deal. I'm not really set up for that. We're a nonprofit, and math, we were talking, math is not my strongest subject. I can do it. I have my trusty calculator, but it's not always as cut and dried as, you know, get the credit. But it's there. And the nice thing about PHFA is these guys are on the list. So then that says to the client, it's a reputable outfit, it's somebody they can have confidence in, you know, as opposed to some of the other lenders who maybe
now as well know. Other questions?
Thank you, Sherry. Thank you very, very much.
Thank you guys for having me. It was great. You warmed up at the end finally. I was like, they're not asking any questions? That's crazy.
Are you getting your card?
I have cards, absolutely.
Literally probably from 3 times I've had it.